The simple thing is when gold's at 2,500 or even 5,000, we'll be glad we have it to protect the obvious dilution of our purchasing power of our national currencies, but everything's going to cost more too, and people are going to be suffering more. But for those, who played the long game here, this isn't an I told you so moment. This is something we've been seeing for years.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for March 4th through March 11th, 2024, while supplies last. First, we feature backdated 1-ounce silver maples at $3.39 over spot. We also have circulated British gold Queen Elizabeth sovereigns at $26.99 over melt. And finally, we're offering our choice 1-ounce Palladium bars at just $119 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Matthew Piepenburg from von Greyerz AG. Matthew, thank you so much for joining us today.
Oh, Elijah, I'm glad to be back. It's good to talk to you. There's lots to go on as usual.
It's definitely a lot going on today in the markets. For gold, we're seeing, I believe Friday was an all-time high close for gold, and now we're seeing gold above 2,100. We've never sustained a level above this price point. What is your take on the strength we're seeing in gold today?
Well, there's a combination of fundamentals and technicals. There's folks smarter than me who track the technicals. To me, the strength we're seeing today is just the beginning of a much longer book, a much longer bull cycle in gold, not in a straight line. All the fundamentals of why gold is important, not just to central bankers and a few smart hedge fund managers and a small minority of very far-sighted precious metal investors. The world is falling into place. And I say falling, collapsing into place in a lot of ways for gold. That's not an exaggeration anymore. It's not sensational. Hedge fund managers that I admire, and I'll caveat that I've allocated to, like Jeremy Grantham at GMO understands gold, Druckenmiller understands gold, Paul Singer at Elliott understands gold, and miners in particular in the value play. But they see what we've been talking about for years and has accelerated dramatically since the weaponization of the world reserve currency back almost 2 years ago to the date in 2022. The de-dollarization theme that was fringe and conspiracy theory is now becoming undeniably important. The tier 1 asset status of gold, the fact that central banks since 2014 have been stacking physical gold at record levels and letting go of U.S. treasuries at record levels. You can no longer castigate those signs and that evidence to the fringe of gold bug, kooks. It's simply the reality of the markets. The policymakers and the mainstream financial media will do their best to continue to drag the retail plankton into the whale of Wall Street to chase these market tops right now, and that's fine for speculators. But the simple fact of debt markets, credit markets, and currency markets, and their last breaths, not their last breath, but their last breaths, are now becoming more and more undeniable. The words and tricks of policymakers and mainstream media, which is highly corporatized, aren't having the same impact on informed investors and even less informed investors, because regardless of the signposts that are officially laid out there, the realities in front of most Americans and most investors are becoming more and more clear. And it's not just that gold loves chaos and gold will go up as heightened fears rise. Gold loves to punish wayward policymakers and the unwritten or unspoken sins of living beyond our means in debt and debasing our currency and trying to seduce the masses with clever words rather than honest math. And so again, long-winded way of saying the fundamentals are returning because, as Egon, my partner and colleague von Greyerz always says, the best friend, ironically, for smart and informed and long-sighted gold investors is our central bankers themselves, and the Fed in particular. As the Fed becomes more cornered and more desperate, and as the need to issue more debt becomes more inevitable, the debasement of the currency is more inevitable. And this is something von Mises warned about. This is something Thomas Jefferson warned about. This is something Ernest Hemingway warned about. This is something Rogoff and Reinhardt were warned about. These are just the inevitable symptoms of a debt cycle and a fourth turning and a karmic reality for mismanaged central planning, mismanaged central banks and monetary policy since 1971. And it's been slow and steady in favor of gold. Now it's accelerating. Like Hemingway's description of poverty, it starts slowly. We've beaten this up, but it happens all at once at some point. And long story short, that's why gold is starting to hit new highs. These are not the all-time highs. They'll go much higher than this in the future, and that won't be in a straight line necessarily. But between what's happening in the global debt markets, what's happening in the retail space becoming more informed, what's happening with portfolio managers becoming more informed, central bankers becoming more informed, I think even these market bubbles, which we can talk about, are starting to seem surreal even to the speculators. So there's just so much happening in such a strange way that all, I think, bode very, very well for physical gold. And what's happening, we can talk about too on the COMEX or the silver markets or the gold markets and the London exchange and the New York exchange. It's historical right now. So they're all signposts that things are not the end of the world, but things are cracking in undeniably obvious ways.
Now, I would like to get to what is happening on the exchanges. First, though, I'd like your perspective on, it does seem very significant to me that we're breaking above this $2,100 level. And a lot of people have been saying, that this has been resistance for a couple of years now, this price point. And so what do you expect from here? Do you expect a major run up? Or do you kind of expect, I know Peter Grandich we had on said it's going to be an arm wrestling match to 2,500. So what is your take on what we're going to see in the coming months?
I agree. I think the target is easily 2,500 between now and then. When you break that technical line of resistance, you would normally expect, and I hate to say it, the usual suspects in the COMEX to start putting a boot to the neck and sending out large paper shorts to kind of artificially manipulate that market. The reality that we're seeing right now, for a number of reasons, way past Basel III, is that COMEX has less and less ammunition and less focus on gold and silver right now. First of all, there's simply undeniable, really fascinating things happening with Andy Schectman, who you know very well, has talked very brilliantly about and has been tracking. He's been tracking for years, but is always one step ahead of what's happening on the COMEX and the silver markets and the gold markets there, and also in the silver and gold exchanges in London. I mean, again, he made the comment the other day about JP Morgan, in the past had almost a nearly $1 billion fine for the sin of manipulating the gold price, which they are not alone in doing. And now they've got, I think, 45 million ounces of gold off their books, but in their coffers, so to speak, another 1.2 billion ounces of silver. So what they're doing behind the scenes with an asset they used to manipulate, they're now stacking, just like the central banks in Saudi Arabia, China, Russia, India, and other BRICS nations. So the COMEX is taking full delivery, large amounts. I mean, the silver level on the COMEX right now is at record lows, and in London and in New York, so there's simply not enough supply there to meet the demand and the deliverables. Once those hard assets that are highly levered to short the markets in the past leave the COMEX, they don't come back in very easily. And so I think when you break a technical line of resistance on the spot price, at the same time that the COMEX and the London markets are running out of physical assets to manipulate those markets, at the same time that central banks and more shadow banking or shadow advisors are buying physical gold and paper gold, it's getting harder to manipulate that price. I wrote an article a few weeks back, just about the fact that now you have a Shanghai gold exchange, you have a Shanghai oil market, you have a Shanghai gold market. We're going to see the same thing in Russia with the Moscow World Standard. All this post-2022 sanctions, you can't have 3 different gold markets and only have one manipulating them. So the power to manipulate precious metals in the past is slowly but steadily changing. The outflows out of the COMEX and the LBMA banks and the London exchanges is historical. It's literally historical. So that, in a combination with the technical signals we're seeing when you break resistance, you'll see higher highs and lower lows. You'll see less ability by the usual suspects to manipulate the paper price, which we all know happens. There's some who argue that that's not true. It's simply undeniably true. And at the same time that the COMEX and the silver markets and the gold markets in London and New York are running out of literal physical ammunition, they're also having to worry about manipulating the Bitcoin price through, the new ETFs there and the spot price Bitcoin ETFs and the mining games that they're playing with Bitcoin. So they've got these two anti-fiat powerhouses, precious metals and now Bitcoin. They've been able to regulate gold for years through the LBMA markets and the OTC markets and the COMEX in New York and London. Now they're trying to put their attention towards Bitcoin, which they'll probably manipulate and keep range bound. I don't think they'll be able to keep gold and silver as range bound as they have. And so, another long answer to a short question, the combination of the technicals and the fundamentals we talked about, as well as what's happening in the COMEX and LBMA banks and exchanges, is converging in a powerful way. At the same time, the debt levels are rising, nearly 9 trillion and US treasuries have to be coming to maturity this year, that there's going to be more obvious synthetic liquidity, that there's more stress in the credit markets, that we are seeing a recession all over the world in some of the largest economies, including Germany, and the gold price is rising. So I think it will be an arm wrestle to 25, and then it'll get past 25. And again, it's because the currencies are going to get weaker and the system is cracking that gold is going to get stronger. As Rick Rule has said, and I've always said, and Egon has always said, we're glad to see gold rise. We're not surprised to see gold rise. It's going to be a sad day for the rest of the world as gold rises, but the prices of things are going to rise. And if wages don't keep up, they can manipulate inflation. But the simple thing is, when gold's at 2,500 or even 5,000, we'll be glad we have it to protect the obvious dilution of our purchasing power of our national currencies, but everything's going to cost more too, and people are going to be suffering more. But for those, who played the long game here, this isn't an I told you so moment. This is something we've been seeing for years.
And I would like to get into what is happening on the major exchanges. We are seeing a draining, I've been hearing, of the major exchanges in London and in on the COMEX. So your perspective on that, it doesn't seem like it's just gold, it's also silver.
Oh, I mean, silver is at all-time lows on the silver exchange right now in London. I mean, it's never been lower. The London Silver Exchange is the lowest ever. It's 70% of the registered silver is drained out of the COMEX in the last 18 to 19 months. Again, Andy has talked about this brilliantly. And, keep in mind that, many of us who follow precious metals know that only 0.5% of global financial assets are in gold, for example. As you see the COMEX draining out, it's a one-way street, as Andy said. It is a one-way street. It doesn't just refill. But if, the vast majority of private wealth management offices, banks and advisors and fund managers ignore gold because you can't churn it, you can't get fees off it, you can't spin it like you can risk assets or bond jocks on what were the prop desks at the big banks and now at the smaller banks flowing money. Physical gold is a finite asset of infinite duration, but it's 0.5% of global financial assets. Now the 4-decade mean is 2%. So just think, if we revert back up to the mean of 2% of financial assets being in gold, that's a 4x increase in demand, which I think mean reversion goes up and down. Mean reversion on the stock market means it's heading way down. Mean reversion in gold assets means it's heading way up. So as markets hit all-time highs that no one believes in because they're nosebleed highs and they're unsustainable, and global central banks are stacking gold and fiat currencies are losing purchasing power, that 0.5% is going to revert back to a mean of at least 2%. And just the demand increase alone, just to revert back to its mean purchasing or mean allocation levels, is going to be another massive tailwind for gold. When you combine that with the one-way emptying of the exchanges in New York and London, as exchanges in Shanghai and Moscow gain more momentum among the BRICS to settle trade agreements among the BRICS nations to net settle in commodities like gold as opposed to US dollars, there is a seismic shift happening in global markets. There is a seismic shift happening in de-dollarization. There's a seismic shift happening with the DXY, which has gone from 115 to 104. If the DXY dips below 100, that's another key trading range for the dollar. And as gold hits 2100, that's another key resistance line broken. So all these things are happening simultaneously, and they all can be stovepiped into 40-minute conversations on each one of those, but they're all fascinating. And they're all ultimately bullish for gold. Again, doesn't mean it's a straight line, doesn't mean there won't be mechanizations, black and white swan events in between now and then, but it's fairly clear that the combination of de-dollarization, the combination of debt levels, the combination of monetizing the debts, combination of these new exchanges, the combination of the COMEX and London exchanges emptying out their assets in a one-way fashion, and the combination of investors no longer trusting this market top for good. It's burnt into the consciousness now that things are changing. And then you bring in the Main Street recession denial and reality, whether that's in Germany, the UK, the US, China. The world is trusting this new tier one asset, gold, a lot more than the IOUs of government X, Y, or Z, including Uncle Sam. So it's fascinating time. And these stock markets are fascinating. I think they couldn't be more of a dangerous sign right now. And that's something worth conversation, I think, are talking about as well. It's just these markets, these equity markets.
Definitely. And the equity markets, it's interesting because they're hitting all-time highs here in the US, but it's a very narrow sector, mainly the technology sector, that's actually rising. So if these major money managers or these people who have their 401ks, right, are not invested in the technology sector, then they're probably not doing very well. So as we see gold rise, what kind of shifts do you think we'll be seeing into the gold market, a market that actually is doing a bit better?
Well, it's interesting. Like I said earlier, when you see, again, very respected funds. Look, when I was a family office managing director, there was very few funds that we admired more than Elliott and the Singers, Paul Singer. I mean, this was a fund that you had to wait in line, even with billions, to get into because you so valued their analysis. To see an allocation from funds like Elliott into mining or into gold is a big deal. There, I think. I haven't looked at the actual allocations. We won't know, but, Elliott's going into Barrick and Newmont because they see the massive delta between the spot price of gold and the equity price of some of these miners. They see an absolute value play that they're not seeing in the S&P or in the NASDAQ. And again, you've got Druckenmüller and others that are looking at gold, obviously Paul Tudor Jones, other big names. So it's no longer just the gold bugs that are talking about precious metals. But it's fascinating to see those type of names understanding gold because they're really looking at valuations. And you look at someone like Jeremy Grantham in Boston at GMO, another manager that I've allocated to. I'll caveat, so there's a bias there. But Jeremy Grantham's been around. He's seen a few market cycles and a few bubbles before, and he has said that the current S&P is shockingly overpriced, and he's not, again, a gold bug or a gloom and doomer, but he's looking at least a 60% market mean reversion here. I've been talking about an S&P at 3,000 or 2,500 or less for years, not based on being gloom and doom gold pushing or fear pushing, but just looking at understanding mean reversion in the markets. So they are shockingly overvalued. There's the law of physics. For every action, there's an equal and opposite reaction. When you get bubbles this high, this narrow, this concentrated in tech, which is making the S&P effectively a tech ETF, it's 33% of the market cap. By the way, the other 493 names outside of the Magnificent Seven effectively have been profitless for the last 2 years or 3 years. So you really have the 500 market cap weighted stocks. They're supposed to be the best 500 companies in America, but for a small handful are negative returning. So going back to what we've learned from history, and you look at the bigger the bubble, the bigger the reaction, the longer the duration of the pain, the longer that V-shaped recovery doesn't happen. The most classic example, of course, is the Nikkei 89. That was over 34 years ago. It still hasn't recovered its highs in nominal terms, not just in the market, but in real estate and land values. The backdrop for this current bubble right now with the S&P at all-time highs couldn't come at a worse time, because unlike 1989 or the bubble of 2000 or 2008, the subprime bubble or the tech bubble in 2000, we have a debt to GDP ratio that's simply unbelievable and irrational. We have a global debt problem. We have a global recession problem. We have geopolitical problems. The backdrop for a market tanking now, because all markets do mean revert and all bubbles do pop, and this is a bubble. We'll go into why and why this time is no different. It couldn't come at a worse time. I don't even think Powell likes to see the S&P this high. This is not what we want to see, because this is the last good narrative we have left. We've seen bubbles even the last few years, whether it was in Peloton or Zoom or Moderna or ARKK. Or even IPOs. Those have all dried up. This is it. This is the last bubble. It's the Magnificent Seven, which now is really the Magnificent Five, because I believe Apple and Tesla have dopped out. But when you have this much concentration risk, you can't deny it. And you also cannot say that this is something that you couldn't see coming. You could see 1929 coming. You could see other bubbles coming. I mean, 29, 72, and 2000, you had 35 times earnings. That was a bubble, the dot-com bubble. We're now at I think the Shiller PE ratio is at 33 or 34. You see it coming. And for those that would say, and again, I was a hedge fund manager during the dot-com bubble of 2000, 1998, 1999. And I've never been embarrassed to admit that I did very well in that bubble based on one IPO, my one quote unquote NVIDIA of 1999, 2000. It was a pre-IPO that made me an irrational amount of money that I didn't deserve, that no one deserves. But it was the sign of the times. It was a sign of that bubble. I've been through market bubbles. I've seen them. I've literally seen tech bubbles before. I look at the Magnificent Five today, and people say, "No, this time is different than the last one. You had a bubble, but now we have real profits. We have real earnings. This is a fundamentals driven bubble. This is not 2000." Again, I'll say it, and I'll say it over and over. I remember looking at Qualcomm and at Microsoft and at Cisco. These were good companies then, good companies now. They were just overpriced companies. I'm not saying NVIDIA goes to zero or Facebook. I'm not a big fan of Facebook for a number of reasons. I'm not even saying that Microsoft or NVIDIA go to zero. I'm saying there's just overpriced companies. And you see this over and over. These bubbles start on fundamentals. They did in 99 and 2000, not the IPOs I was in, but the big names on the NASDAQ and the S&P in those days were profitable. But what happens when you get these margins? It's all about expansion and contraction of margins. That's how bubbles are formed. When you're making profits, and gosh knows NVIDIA has been having huge profits in 21. Its numbers went to the billions. It lost in 22 and 23. Its profits were over 19 billion. It's not a non-profitable company, but it's still overvalued. And the advantages it has as the price, cost, and volume are not sustainable. And so when you get a net contraction in the margins, as we've seen in prior bubbles, the bubble will end. I don't know when, I just know how. These are margin-driven, expansion-driven margins that are not sustainable. The sad thing is when you have an S&P this concentrated, and when it does revert to its mean, when it does pop, as all bubbles do, doesn't mean that's the end of those companies. There's nothing left. There's no good narrative left for the U.S., for the U.S. hegemony, for the U.S. economy, because we can get into the recession indicators, the labor indicators, the inflation indicators. There's nothing left. Even the Conference Board leading indicators is saying, well, we're not looking at a recession now, we're looking at a slowdown because the markets are doing so well. But what is the markets? The markets are five names, highly concentrated, and their cost of capital is different, and their advantages and the margins are not sustainable. So I promise you, it will eventually pop. Doesn't matter when. If you're chasing these tops, by the way, there's never been a higher point in our history where insiders are dumping their stocks at the tops. It's not just Bezos. These are smart guys. They're not in it for social justice. They're not in it for the rest of the world. They're going to get out. They're going to pump up and spoof the markets up. They're going to take this FOMO on the profits. They're going to get maximum valuation when they exit quietly. And the retail plankton will chase those tops. But unlike a lot of hedge funds and sophisticated traders, the retail investors that are building this bubble won't know what signals to follow when it's time to get out. And when that liquidity need is there, when you need to get out, the exit door will be the size of a mouse hole. And a lot of retail investors are going to get spanked. And, again, this faith in AI, this dystopian faith in technology, this idea that's been pandered, I guess I keep thinking of the Theranoses of the world, the Adam Newmans of the world, the Sam Bankman-Frieds of the world, the Mark Zuckerbergs of the world, the former heroes that we thought, or again, Adam Newman, the Sam Altman today. These young Turks are just young turkeys. They're not in it to make America a better place for the middle class or for retail investors. They're in it for themselves to spoof, pump, dump, and stay in business. And so this market bubble literally couldn't come at a worse time because it is too concentrated. There's not enough companies behind the Magnificent Five to keep the S&P up. So that's, again, part of the reason you're seeing gold and precious metals going up is no one's really buying this narrative, and they can keep it going for a while. I don't know when it pops. I just know how it pops. I do know when it does. In addition to all the other problems we have in the world globally and economically, there'll be no good narratives left. And that does make me worry about the Ablenkung, the distraction that will come from war, from global warming, from COVID, from pandemics, from Putin, whatever. There'll be a need for a bigger bad guy to explain the disasters that are currently happening that are coming. There'll be more centralization. There'll be more capital controls. There'll be less civil liberties. There'll be more distraction, more political infighting, and sadly, more foreign military drum rolls. And that we're seeing in real time right now. We're also seeing that the official report of inflation is a joke, and everyone knows it. So there is no other good narrative right now other than this grotesquely overvalued stock market that a lot of smart and honest portfolio managers are calling uncle on it. They're calling BS on it. They see it for what it really is. And again, couldn't come at a worse time.
Now, getting back to gold, as we're seeing it above 2100, as we talked at the top of this interview, um, a lot of people have been predicting a melt up, right? Where the stock market rises and gold rises, and then there's going to be this crash. If we see the stock market crash, as you've been talking about, do you anticipate a pullback in gold? So, what should people be thinking about? Should they be kind of cautious getting into gold right now? Your perspective.
Look, there's always been a warning. I've always said that gold can be very sympathetic in the first 10 minutes of a market meltdown, especially after a large melt up. We've seen it. I've seen it in the gold markets. I've also just seen it as a risk asset manager when you're getting the phone calls. People and funds need liquidity when their risk asset portfolio is getting spanked. And so they can get instant liquidity by converting their gold into a currency at that time to cover margins or to cover losses. And so it's very often the case where you see a temporary pullback in the gold price after a significant meltdown following a melt up. And that pullback doesn't last very long. It's a great buying opportunity. You could argue now that it will be somewhat different in the next meltdown, that gold may not be sympathetic down for very long or at all, because there is such a limited supply of the actual physical gold that it will be carried more carefully and held more tightly in the next major drawdown. Again, when you see JP Morgan stacking gold, when you see central banks stacking gold, when you see private investors holding on to it carefully, it'll depend on how over their skis individuals, certain shadow banks, certain funds, and certain institutions and certain central banks are when that moment comes, how prepared and liquid they are outside of their gold holdings. Because there is a risk that there'll be a pullback. That isn't, to me, a buying opportunity. I wouldn't count on that as a pullback to buy. In this particular macro environment, in this debt environment, in this very carefully held demand now for physical gold and a very limited supply, I wouldn't rely on that as a pullback opportunity. Again, compared to the broad money supply, gold today is as cheap as it was in 1971 if you get it before everyone else wants it. Now everyone else really wants it. And what we're seeing on these New York and London exchanges is they want it. And they don't just want it because they want to buy Bitcoin. They want it because they want it. They need it as a hedge against a national currency like the US dollar, despite all its power sources and despite the milkshake theory, for which I have a tremendous respect. The simple fact is the world knows that this tier one asset of gold is a better tier asset than the U.S. Treasury, and that U.S. Treasury is married at the hip to the U.S. dollar. And since 2022 and the sanctions against Putin, whatever you think of that war, whatever you think of Putin, the fact that we weaponize the world reserve currency, there's no doubt that the trust in that dollar has changed dramatically. And the need for gold has risen dramatically. And that these new all-time highs will not have the same susceptibility to manipulation like they did in the past by a COMEX that has been neutered of its physical supply, and the London exchange has been neutered of its physical supply at the same time that the Shanghai and Moscow exchanges are now rising in influence and power as the BRICS gain more power post-weaponization of the US dollar in 2022. They're all related. It's alles ist verbunden, as we say. It's all connected. It's no longer the gloom and doom narrative that they used to say about gold bugs in the past. None of us have been gold bugs. All of us were in risk assets. All of us understand credit markets and equity markets. We didn't come to gold to make speculation. We came because we saw the slow death of the U.S. currency and the open desperation of our central banks.
Well, Matthew, we always appreciate having you on. If our viewers are interested in learning more about your work, where can they find you?
Yeah, we're at vongreyers.gold or vg.gold. We were formerly Matterhorn Asset Management, but as you probably noticed, we've changed the name to Von Greyerz only because our founder and our chairman, Egon Von Greyerz, is just someone whose reputation and name and influence in the space is so good. We thought this is the time, as we redid the website, to officially change the name. And the website has been greatly enhanced. It has a whole section, obviously, with my articles, Egon's articles, etc. But it also has a whole section on why gold. It's more than just understanding gold or silver. It's how to own gold and silver, how not to own gold and silver, in particular, not in ETF form, and certainly not stored at a commercial bank. So, and it also talks about jurisdiction choices, whether you're an American or non-American, the understanding of the smart, legal, safe ways to own gold privately. So there's a lot more to it than just the argument of why to understand physical precious metals and gold and silver. And so vongreyers.gold or vg.gold is where you can find us, and always an article or an interview somewhere on there.
Fantastic. Matthew, thank you so much for your time. Any last thoughts before we let you go?
Just keep being cynical, keep being smart. Fact check everything I say, fact check the sell side says, and understand history and math, and I think you'll understand gold and silver a lot better.
Thank you so much, Michael, and God bless.
God bless, Elijah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for March 4th through March 11th, 2024 while supplies last. First, we feature backdated 1-ounce silver maples at $3.39 over spot. We also have circulated British Gold Queen Elizabeth sovereigns at $26.99 over melt. And finally, we're offering our choice 1-ounce Palladium bars at just $119 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.